Let me tell you something that changed my entire understanding of wealth building. It was not a stock tip. It was not a secret formula. It was a simple realization about what is actually required to turn a modest sum into a life-changing Fortune 20, $5,000 into $250,000, a 10 times return. Most people think this requires genius-level stock picking. They think it requires finding the next Amazon or Apple before anyone else. They think it requires taking enormous risks and getting lucky. They are completely wrong. Turning $25,000 into $250,000 by age 50 is not about finding moonshots. It is about understanding the mathematics of compounding and having the discipline to let it work. It is about avoiding mistakes more than achieving brilliance. It is about time in the market, not timing the market. Let me show you exactly how I would do it if I were starting today with $25,000 and a goal of reaching $250,000 by age 50. This is not theory. This is the practical application of everything I have learned over 7 decades of investing. But first, let me take you back to where my own journey began, because the lessons from those early years are exactly what someone with $25,000 needs to understand today. I bought my first stock when I was 11 years old. It was 1942, right in the middle of World War II. I had saved $114.75 from delivering newspapers, selling golf balls, and various other odd jobs. My sister Doris had saved a similar amount. And together we bought 3 shares of Citi's Service Preferred at $38.25 per S-share. The stock immediately dropped to $27. I watched our investment lose almost 30% of its value. I was terrified. My sister reminded me every day that I had lost her money. When the stock finally recovered to $40, I sold immediately, relieved to have made a small profit. Then I watched that same stock climb to $200 per S-share. That experience taught me the most expensive lesson of my early investing career. I learned about patience. I learned about conviction. I learned that the biggest returns come from holding great investments through volatility, not from trading in and out based on fear and greed. If I had simply held those 3 shares, if I had done nothing but wait, my small investment would have multiplied 5 times. But I sold because I was scared, and I missed the gains that patience would have delivered. This lesson is worth more than any stock tip I could give you. If you want to turn $25,000 into $250,000, the most important skill you need is the ability to do nothing, the ability to buy quality and hold through whatever the market throws at you. Now, let me get specific about how I would approach this goal. The first thing I would do is determine my time horizon. If you are 30 years old and want to reach $250,000 by age 50, you have 20 years. If you are 40, you have 10 years. The time you have determines the strategy you should follow. With 20 years, turning $25,000 into $250,000 requires a compound annual growth rate of about 12%. That is achievable through disciplined investing in quality stocks without taking excessive risks. With 10 years, you need about 26% annually. That is much harder and requires either exceptional stock selection, significant additional contributions, or accepting more risk than I would generally recommend. Let me focus on the 20-year scenario because it is realistic and does not require heroics. 12% annually for 20 years. That is the target now. Some people will say that 12% is optimistic. The stock market has historically returned about 10% annually. How can you expect to beat the market by 2 percentage points every year for 20 years? Here is my answer. You do not need to beat the market by stock picking. You beat the market by avoiding the mistakes that cost average investors 2 to 3 percentage points annually. You beat the market by keeping costs low, by staying invested through downturns, by not chasing hot stocks and selling at the worst possible times. The average investor significantly underperforms the very funds they invest in because of behavioral mistakes. They buy after stocks have risen and sell after stocks have fallen. They pay excessive fees to active managers who underperform index funds. They trade too frequently and give up returns to transaction costs and taxes. If you simply avoid these mistakes, if you invest in low-cost index funds and hold them regardless of what the market does, you will outperform most investors. The 12% target becomes achievable not through brilliance, but through discipline. So here is the specific strategy I would follow. I would put the entire $25,000 into a low-cost S&P 500 index fund, not a portion of it, all of it. I know this sounds boring. I know you want me to tell you about some undiscovered stock that will make you rich, but the truth is that the S&P 500, owned through a low-cost index fund, is one of the best investments available to someone with $25,000. The S&P 500 contains the 500 largest companies in America. It includes Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 other businesses. When you buy an index fund, you own a small piece of all of them. This diversification eliminates company-specific risk. You do not have to worry about whether any single company will succeed or fail. You are betting on American business as a whole, which has been one of the most reliable bets in economic history. The cost of owning an S&P 500 index fund is almost nothing. The expense ratios on the best funds are 0.03%. That means for every $10,000 you invest, you pay $3 per year in fees. Compare that to actively managed funds that charge 1% or more, and you can see the advantage. Over 20 years, the difference between paying 0.03% and paying 1% in fees is enormous. It could mean the difference between reaching your goal and falling short. Low-cost compound just like returns compound not. Some people will argue that I should pick individual stocks instead of an index fund. After all, I have spent my career picking stocks. Why would I recommend an index fund? Here is the honest truth. When I was starting out with small amounts of money, I could find opportunities that are not available to someone managing billions of dollars. Small companies that were overlooked, special situations that required only a few $1,000s to exploit, inefficiencies in the market that have since been arbitraged away. Those opportunities still exist, but finding them requires full-time dedication to investing. It requires reading hundreds of annual reports. It requires developing expertise in specific industries. It requires making investing your primary occupation, not a side activity. If you are a doctor or a teacher or an engineer, you cannot dedicate the time necessary to find these opportunities. You should not try. You should stick with the index fund, do your actual job well, and let compounding work for you. But let me also share what I would do differently if I were truly committed to beating the index, because some of you watching have the time, the interest, and the temperament to be active investors for you. The path to turning $25,000 into $250,000 can be accelerated. The key is concentration. If you find a truly outstanding business trading at an attractive price, you should put meaningful money behind it. Not 1% of your portfolio, not 5%, a meaningful amount that will actually move the needle if you are right. I have said many times that diversification is protection against ignorance. If you do not know what you are doing, you should diversify broadly. But if you have done the work, if you truly understand a business and its competitive position, concentration is how you build wealth quickly. When I was managing small amounts of money in my 20s and 30s, I often had 50% or more of my portfolio in a single stock. This was not reckless. I had done the analysis. I understood the businesses. I knew what I owned. The concentration allowed me to compound at rates far above the market average. But I want to be very clear about something. This approach requires genuine expertise. It requires understanding accounting and financial statements. It requires understanding competitive dynamics and industry structures. It requires emotional discipline to hold through volatility without panicking. If you do not have these skills, you will lose money trying to concentrate your portfolio. The index fund is the safer and probably better path for most people. Let me now talk about the second critical element of reaching $250,000 by age 50. It is not just about how you invest the initial $25,000. It is about adding to that investment over time. Here's a mathematical reality that most people do not fully appreciate. Regular contributions matter enormously for building wealth. The initial $25,000 is your starting point, but what you add along the way determines your ending point. Let me show you the numbers. If you invest $25,000 and earn 10% annually for 20 years with no additional contributions, you end up with about $168,000. That is good, but it is short of your $250,000 goal. But if you add just $300 per month, just $3,600 per year while earning 10%, you end up with about $420,000. That is nearly reaching your goal with market average returns. No stock picking required. The additional contributions are doing most of the heavy lifting. The initial $25,000 grows to $168,000. The monthly contributions grow to about $252,000 together. You blow past your goal. This is why I tell people that the savings rate matters more than the investment return, especially in the early years. If you can increase your monthly contribution from $300 to $500, you accelerate your timeline dramatically. If you can find ways to save more, to live below your means, to prioritize investing over consumption, you build wealth faster. I have watched people obsess over getting an extra 1% return while ignoring opportunities to save an extra $100 per month. This is backwards. The extra $100 per month matters more, especially early in your investing journey. So my practical advice for turning $25,000 into $250,000 is this. Invest the initial amount in a low-cost index fund. Then set up automatic monthly contributions of whatever you can afford, $300 minimum, more if possible. Then forget about it. Do not check your balance every day. Do not react to market moves. Just let the system work. In 20 years, with average market returns and consistent contributions, you will likely exceed your goal. No genius required, no stock picking required, just discipline and patience. Now let me address some obstacles that derail people from this straightforward path. The first obstacle is fear. Markets decline. Sometimes they decline a lot. In 2008 and 2009, the stock market fell over 50%. If you had invested $25,000 at the peak in 2007, you would have watched it shrink to $12,000 at the bottom. Most people cannot handle this psychologically. They sell at the worst possible time, locking in their losses. Then they wait on the sidelines while the market recovers. They miss the gains that would have made them whole, and then some. I have lived through 14 major market declines every single time. The market recovered and went on to new highs every single time. Investors who held through the decline were rewarded for their patience every single time. Investors who sold at the bottom regretted it. The fear is real, I understand it, but you have to push through it. You have to remember that market declines are temporary while market gains are permanent. If you hold long enough, you have to remember that you are buying businesses, not pieces of paper, and businesses keep operating and earning money even when their stock prices are depressed. The second obstacle is greed. This is the opposite problem, but equally damaging. When markets are rising, when everyone is making money, when your coworker is bragging about doubling their portfolio on some hot stock, the temptation to chase returns is overwhelming. You want to abandon your boring index fund and buy whatever is going up. You want to concentrate in the hottest sector. You want to use leverage to amplify your returns. You want to catch up to all those people who seem to be getting rich faster than you. This is when the worst mistakes are made. The hot stocks are hot because everyone already knows about them. The prices already reflect the optimism. Buying high because of greed leads to selling low when the bubble pops. I have seen this cycle repeat countless times. The late 1990s with internet stocks, 2007 with real estate, 2021 with meme stocks and cryptocurrencies. Every time, people who chased the hottest investments ended up worse than those who stuck with boring, diversified portfolios. The discipline to ignore both fear and greed, to stick with your plan regardless of what everyone else is doing, is the most valuable skill an investor can develop. It is more valuable than understanding balance sheets. It is more valuable than predicting the economy. It is the skill that separates those who build wealth from those who destroy it. The third obstacle is impatience. 20 years feels like a long time when you are starting out. You want results now. You want to see your portfolio grow every month, every week, every day. But wealth building does not work that way. Most of the gains come at the end because of how compounding works. In the early years, the absolute dollar gains are small, even if the percentage returns are good. 10% of $25,000 is just $2,500. That is not life-changing. But 10% of $200,000 is $20,000. Same percentage, but much larger absolute gain. The portfolio gets big and then the gains become meaningful. This is why patience is so important. You have to endure the early years when progress feels slow. You have to trust the math even when the results do not seem impressive. You have to stay invested long enough to reach the part of the curve where compounding really takes off. I made most of my money after age 60. The first several decades of investing were about building the base. The later decades were about watching that base compound into something enormous. The same pattern will apply to you if you have the patience to let it unfold. Let me talk about some specific actions that can accelerate your progress toward the $250,000 goal. First, maximize tax-advantaged accounts. If your employer offers a 401k with matching contributions, that is free money. The match is an instant 100% return on your contribution. There is no investment that can compete with that. Beyond the match, the tax deferral in retirement accounts allows your money to compound without annual tax drag. This can add significantly to your ending balance. The difference between investing in a taxable account and a tax-advantaged account over 20 years can be 30% or more. Second, keep your investment costs low. I have already mentioned expense ratios on index funds, but also watch out for trading costs, advisory fees, and account fees. Every dollar you pay in fees is a dollar that is not compounding for your future. Some people pay financial advisors 1% of their assets annually for advice that does not improve their returns. Over 20 years, that 1% fee consumes a huge portion of your wealth. Do the math and make sure any fees you pay are justified by the value received. Third, avoid the temptation to tinker. Every time you make a change to your portfolio, you incur costs, transaction fees, taxes on gains, and the spread between buying and selling prices all take bites out of your wealth. And most changes people make actually hurt their returns because they are driven by emotion rather than analysis. The best investors I know make very few changes to their portfolios. They buy quality investments and hold them for years or decades. They resist the urge to react to every piece of news or market movement. Their patience is rewarded with higher returns and lower costs. Fourth, reinvest all dividends automatically. Dividends are a significant portion of total stock market returns over long periods. If you spend your dividends instead of reinvesting them, you are dramatically slowing your wealth building. Set up automatic dividend reinvestment so that every dividend payment buys more shares without any action required from you. This keeps the compounding machine running at full speed. Fifth, increase your contributions over time. As your income grows, your investment contribution should grow too. If you get a raise, put half of it toward increased savings. If you pay off a debt, redirect those payments to investments. Lifestyle inflation is the enemy of wealth building. The people who reach their financial goals are not necessarily those with the highest incomes. They are those who consistently live below their means and invest the difference. This habit, maintained over decades, is more powerful than any investment strategy. Now let me share some thoughts on mindset, because the psychological aspect of wealth building is as important as the technical aspects. You need to think of yourself as a business owner, not a stock trader. When you buy an index fund, you are buying ownership stakes in 500 businesses. You are partnering with the managers and employees of those businesses. Your wealth depends on their collective success. This ownership mindset changes how you react to market volatility. When stock prices fall, you are not losing money. You are getting an opportunity to buy more ownership at lower prices. When stock prices rise, you are not winning. Your businesses are just being valued more fairly. This long-term ownership perspective is what separates successful investors from unsuccessful ones. Traders try to profit from price movements. Owners profit from business success. Over long periods, owners always win. You also need to accept that some years will be bad. Markets do not go up in a straight line. Some years will show losses. Some years will show small gains that feel disappointing. This is normal. This is expected. This is not a reason to change your strategy. I have had years where my portfolio declined significantly. I have had years where I underperformed the market. I have had years where it seemed like nothing was working. But I stayed the course because I trusted the long-term trajectory, and that trust has been rewarded many times over finally. You need to tune out the noise. The financial media exists to create anxiety. Anxious viewers watch more. Anxious investors trade more. The entire industry profits from making you feel like you need to do something. But the best thing you can do most of the time is nothing. Hold your investments. Continue your contributions. Ignore the predictions and prognostications. The talking heads do not know what the market will do tomorrow. Nobody does. Your edge is patience, not information. Let me close with a broader thought about what this journey really means. Turning 25,000 into 250,000 is not just about money. It is about freedom. It is about security. It is about options. $250,000 invested at age 50 can generate meaningful income for the rest of your life. It can be the foundation for a comfortable retirement. It can provide a safety net for unexpected challenges. It can be passed to the next generation, giving them a head start you may not have had. The discipline required to build this wealth, the patience to let compounding work, the emotional control to stay invested through volatility. These skills transfer to every other area of life. Becoming a successful investor makes you a more disciplined, patient, and thoughtful person generally. I started with nothing. I delivered newspapers and sold golf balls. I scraped together $114 from my first investment, and through the power of compounding, through decades of patience and discipline, I built one of the largest fortunes in history. You do not need to become a billionaire. $250,000 is a meaningful goal that can genuinely change your life, and it is achievable through the simple strategy I have outlined. Invest in low-cost index funds. Contribute regularly. Stay invested through volatility. Let time and compounding do the work. This is not a secret. This is not complicated. But it requires discipline that most people lack. If you can develop that discipline, if you can follow this path for 20 years without deviation, you will reach your goal. You might even exceed it. The choice is yours. The math is clear. The strategy is proven. The only question is whether you will execute it consistently over the years and decades required. I believe you can. I have seen countless ordinary people build extraordinary wealth through these principles. There is nothing special about them except their discipline, if they can do it. So can you start today, invest your $25,000, set up your monthly contributions, then step back and let the most powerful force in finance work on your behalf? Compound interest, given enough time, will turn your modest beginning into a substantial fortune. That is my answer to how I would turn $25,000 into $250,000 by age 50. It is not exciting. It will not make you rich overnight, but it works. And in the end, what works is all that matters. Let me go deeper on some aspects of this journey because I want you to fully understand what you are signing up for and how to navigate the challenges that will inevitably arise. The first few years are the hardest psychologically. Your portfolio is small. The gains are modest in absolute terms. You look at your account balance and it feels like nothing is happening. Meanwhile, you see people on social media bragging about huge returns on speculative investments. You wonder if you are doing something wrong. You are not doing something wrong. You are doing something right. Those people on social media are mostly lying or lucky. The ones who are lucky will eventually give back their gains when their luck runs out. The ones who are lying never had the gains in the first place. Your boring index fund, grinding out 8 to 12% per year, is actually performing brilliantly. It just does not feel that way when the absolute numbers are small. Trust the process. Keep contributing. The feelings of inadequacy will fade as your balance grows. Let me share what the mathematics actually look like year by year, because seeing the progression helps build confidence. Year one, you start with $25,000, you add $3,600 in contributions. Markets return 10%. You end the year with about $31,500. Year five, through consistent contributions and average returns, you have about $68,000. The growth is starting to become visible. Year 10, you have crossed $130,000 now. The annual gains are meaningful. 10% of $130,000 is $13,000. That is more than your annual contributions. The compounding is starting to dominate year 15. You have about $220,000. You can see the goal on the horizon. The portfolio is generating over $20,000 per year in gains. Your contributions are almost irrelevant now compared to the investment returns. Year 20, you cross $250,000 and likely exceed it significantly. The goal is achieved. The journey is complete. This progression is not theoretical. It is what actually happens when you follow the strategy consistently. The early years are slow. The later years are fast. You have to survive the slow years to enjoy the fast years. Now let me address some variations on this strategy for people in different situations. If you are starting later, say at age 40, with a goal of reaching $250,000 by age 50, the math is harder but not impossible. You have 10 years instead of 20. You need higher returns or larger contributions or both. With 10 years, I would still recommend the index fund as your core holding, but you might allocate a portion, say 20 to 30%, to higher growth investments. This could include a technology-focused index fund or a small cap value fund. These investments are more volatile but have historically delivered higher returns over long periods. You would also need to maximize your contributions. Instead of $300 per month, aim for $1,000 or more if your income allows. The larger contributions compensate for the shorter time horizon. The risk with this approach is that you might hit a bad sequence of returns. If the market crashes in years 8 or 9, you do not have time to recover. This is the trade-off you accept with a shorter timeline. You might fall short of your goal despite doing everything right. If you are starting earlier, say at age 25 with a goal of reaching $250,000 by 50, you have 25 years. The math becomes much easier. You can reach your goal with lower contributions or lower returns or both. With 25 years, I would still recommend the index fund approach, but you can afford to be more aggressive in your allocation because you have time to recover from any downturns. A portfolio of 100% stocks is appropriate at this age. You might even consider allocating a portion to international stocks for broader diversification. Something like 80% U.S. stocks and 20% international stocks gives you exposure to growth opportunities outside America while maintaining a strong domestic core. The key advantage of starting early is that compounding has more time to work. 25 years of compounding turns $25,000 into over $270,000, even without any additional contributions, assuming 10% returns. Add consistent contributions and you could end up with $500,000 or more. This is why I always tell young people that the most important financial decision they make is to start investing early. Every year you delay costs you exponentially in final wealth. A 25-year-old who invests $10,000 has the same ending value as a 35-year-old who invests $27,000 time. Is that powerful? Let me also discuss what to do when you reach your goal. Reaching $250,000 is an achievement, but it is not the end of the journey. You need to think about what comes next. If you are 50 years old with $250,000, you have options. You can continue working and let the portfolio grow further. At 10% annually, $250,000 becomes $412,000 in 5 years and $650,000 in 10 years. If you do not need the money immediately, let compounding continue working. You can start withdrawing for retirement income. A common guideline is the 4% rule, which suggests you can withdraw 4% of your portfolio annually with a high probability of not running out of money over a 30-year retirement. 4% of $250,000 is $10,000 per year, or about $833 per month. This supplements Social Security and any other retirement income you have. You can also shift your allocation to be more conservative. At 50, you may want to reduce your stock exposure and add bonds for stability. A common guideline is to have your age as the percentage in bonds. So at 50, you might have 50% stocks and 50% bonds. This reduces volatility as you approach the years when you will need to spend the money. The right choice depends on your specific situation, your other sources of retirement income, your health and expected longevity, your risk tolerance, your goals for leaving money to heirs. There is no universal answer. What I would advise is to think carefully about these questions before you reach your goal. Have a plan for what comes next. Do not let a large portfolio sit without purpose. Money should always be working toward something. Let me share some thoughts on common mistakes I see people make as they approach their financial goals. The first mistake is getting conservative too early. Some people, as their portfolio grows and they approach their goal, become so afraid of losing what they have built that they shift entirely to cash or bonds. This locks in lower returns and may prevent them from reaching their goal. The right approach is to maintain your stock allocation until you are within a few years of needing the money. Then gradually shift to more conservative investments. Do not let fear override the strategy that got you here. The second mistake is getting greedy when things are going well. Some people, as their portfolio grows faster than expected, decide to reach for even higher returns. They abandon their diversified approach and concentrate in whatever is performing best. This often leads to disaster when the hot sector cools off. The right approach is to stick with your strategy regardless of whether returns are better or worse than expected. Rebalance periodically to maintain your target allocation. Do not let greed override the discipline that got you here. The third mistake is counting your chickens before they hatch. Some people, as their portfolio approaches their goal, start spending more because they feel wealthy. They upgrade their lifestyle in anticipation of reaching their target. Then a market decline pushes them backwards and they are stuck with higher expenses and a smaller portfolio. The right approach is to maintain your lifestyle until you have actually reached your goal and held it for at least a year. Do not increase spending based on paper gains. Wait until the wealth is real and sustainable. The fourth mistake is comparing yourself to others. As you work toward your goal, you will encounter people who seem to be building wealth faster. They took concentrated bets that paid off. They got lucky on speculative investments. They inherited money or started businesses that succeeded. Do not compare your journey to theirs. Your path is appropriate for your situation and risk tolerance. Their path may have involved risks you could not afford to take or luck that cannot be replicated. Focus on your own progress, not on what others are doing. Let me also address the question of whether $25,000 is the right starting amount. Some people have more than $25,000 to invest. If you have $50,000 or $100,000, the strategy is the same, but the numbers are different. You reach $250,000 faster or end up with more at the end. The principles do not change with scale. Some people have less than $25,000. If you are starting with $10,000 or even $5,000, do not be discouraged. The strategy still works. It just takes longer or requires larger contributions. The important thing is to start regardless of the amount. I have always said that the amount you start with matters less than the habits you develop. Someone who starts with $5,000 and develops disciplined saving and investing habits will end up wealthier than someone who starts with $50,000 but lacks discipline. The habits compound along with the money if you have debt. especially high interest debt like credit cards. Paying that off may be a better use of your money than investing. The guaranteed return from eliminating high interest debt usually exceeds the expected return from investing. Get rid of the debt first, then start your investing journey. If you have no emergency fund, building one should come before aggressive investing. 3 to 6 months of expenses in a savings account protects you from having to sell investments at bad times when unexpected expenses arise. This foundation of security allows you to invest with a long-term perspective. Let me close with a final thought about what this goal really represents. $250,000 is not just a number, it represents choices. The choice to retire a few years earlier, the choice to work part-time instead of full-time, the choice to take a lower-paying job that you find more meaningful, the choice to help your children with education or a home purchase, the choice to pursue interests and passions without financial pressure. Money is not the goal. Freedom is the goal. Security is the goal. Options are the goal. Money is just the tool that provides these things. When I started investing as a boy, I was not thinking about becoming wealthy. I was thinking about independence. I wanted to be able to make my own choices without being dependent on anyone else. I wanted security for myself and my family. I wanted the freedom to pursue what interested me. The wealth came as a byproduct of pursuing those goals through intelligent investing over a very long time. The same can be true for you. $250,000 provides meaningful freedom and security. It is worth the discipline and patience required to achieve it. Start today. Invest consistently. Stay the course through good times and bad. Trust the mathematics of compounding in 20 years. You will thank yourself for the decision you made today. That is how I would turn $25,000 into $250,000 by age 50, not through speculation or luck or genius, through discipline, patience, and the unstoppable power of compound interest working over time. The path is clear. The strategy is proven. The only remaining question is whether you will walk it